Get started. It's 1 o'clock.
One.
Hello, my name is Paris Williams. I'm the CEO of Next Level Financial. We're a fractional CFO company, and we are very happy to be here today. Part of my role will be to make sure that I stay and keep y'all engaged so that it's not just us talking, it's also your questions and your input. So if you have questions, thoughts along the way, add them in and we'll get to those questions at the end. Very happy to be here. This is one of our favorite things to do is to support business owners who are looking to go to the next level as it relates to finance, right? It's not always everybody's favorite part of the job, but that's okay
Oh,
because it's our favorite part.
oh, okay.
I'm Paris. James, go ahead and introduce yourself, please.
Hello, I'm James. Happy to be here. And I thought finance was the best part of business. At least that's what I tell myself. And I am excited about this topic. We are focusing here on real estate. My background is real estate. I have my background's in accounting, but shortly after I left the public accounting firm, I went to work with a real estate developer, and have worked in the institutional investment space focused on real estate, and on and on. But this is a great topic for me, so excited to jump in and be here with you all. So there it is.
Let's do this.
Okay. Okay, so today we're sort of categorizing this into three major, we'll call it topic points: strategic budget and forecasting. We're going to talk about the optimizing cash flow and margins, and then of course those key financial metrics and making sure we're keeping everything on track. All right, so when we talk about project-based budgeting, and particularly in real estate, there are some unique challenges that come along with that. One, this is not transactional where it's just a one and done type of thing. We're typically working on these projects and with people for months and months and months. Sometimes it's even years. So the long timelines present a challenge because there are always things that are happening in between that start and that finish point that are not necessarily what we had anticipated. We've got capital intensive. There's people intensive. So we've got some things there that we have to consider. And then of course the market fluctuations and regulatory risks, it could be one way for 3 months and then everything changes, for example. And we see that as time moves on, and we are in different types of seasons, be it economic, political, environmental, whatever it is. I like to think about this in terms of a framework. I call it the PMR framework. We're talking about managing finances. And in a project setting, it's about we have to we have to plan properly for it, right? And then we have to manage, and then we have to reflect. And most groups that I have worked with in the past are familiar with the planning and managing, but the reflecting is not necessarily always followed. And so we have to understand how things had gone, after each project, do sort of a post-mortem, if you will, in order to ensure that we're learning from what went well, what didn't go well, and implementing that into our next project. So the best teams do that type of work, and so that's what we're going to talk about here as well.
Awesome. So, what are the most common budgeting mistakes commercial real estate professionals make, and how can they be avoided?
Yeah, so this one is it's actually pretty easy. In my experience, the two common areas are related to scheduling. Real estate projects rarely go to schedule and rarely get finished in the time frame in which they were planned. So whether it be a long project or even some of the smaller projects in between. And so that's a big thing. And the second thing is the contingency component of it, where we're not planning appropriately for some of the things that can happen. Um, you'll see in real estate budgets or development budgets or even construction budgets, you'll see a line item that says contingency. Sometimes it's 5%, sometimes it's 10%, sometimes it's lower. Um, and so we need those, and we need to properly size those. And we also need to make sure that we have enough room up top in some of our other categories as well. So the contingency is huge, and we have to make sure that we're planning for that appropriately. I actually had one case. This is not just one case, but in particular where we didn't plan properly for our contingency and the pre-development phase, and we ended up having to eat about $500,000 in costs. It was not going to be reimbursed by investors or developers or lenders. So we ended up eating that, and we had to we put it on our line of credit, and that sat on our line of credit for some time before we were able to pay it off via another project. But planning is huge when it comes to how we look at our budgets.
Wow. Well, listen, that's how you learn, right? I mean,
Yeah,
sometimes.
it's a hard pill to swallow. It still hurts.
That was a long time ago. Let's move on.
Yeah.
Approximately 85% of construction projects experience cost overruns, with the average overrun ranging from 10% to 20% of the original budget. Talk about it.
Yes, this is what I was saying. I
Mhm.
mean, I don't know, this is a kind of call it a painful reality in this business. But anytime you see 85% of projects, that's a high number. And we in the industry, me as a finance person, uh, should be addressing this in a more proactive way. This should not be the case. And this is part of what we're going to talk about, making sure that we are sizing our project budgets appropriately. So we're not eating costs, or we're not having to suffer under lower returns, or, and the list goes on. So it's a challenge, but we're going to talk about that. All right, so how do we approach this? So I'm going to talk about a couple of key points here in terms of how we approach our budgeting process as it relates to these real estate projects. Now, some may think or say it's like, hey, you do what you did last time, right? You put on a cost per square foot, or you estimate, you get bids from your suppliers, subcontractors, et cetera, and there you go. But the data shows, as we saw in that slide above, that that's just not good enough. So, but what can be helpful here is looking at history. And in my experience, we have many different projects going on, sometimes multiples at a time, and we are jumping from one project to the next. And once one is done, we go on. Well, what I'm talking about here is we've got to take a second, if not more, and really look at, okay, what went well, what didn't go well, and learn from the actual outcomes of previous projects, so that we can really apply some of those lessons, be it scheduling, be it just cost. What can we do to improve our budgeting capacity? So that's one thing. Having a postmortem, getting the team together, half an hour, and really talking about the points of that particular project. It is not just financial points, it's others as well. But not only does that make our budgeting forecasting process better, but it also makes the whole our whole company and approach better to how we're doing things. The other thing is macro concerns. A lot of times we're just looking at our budget and the scenario is like the best case scenario and not paying enough attention to some of the things that are happening or will happen, right? We're kind of hoping that they don't happen, and that's how we're budgeting them. But we really have to build that in. And part of the way we will do that, and we're going to talk about this in a second, is doing some scenario planning, right? For example, we know that, maybe 6 months ago, there was no issue with tariffs, where there was no issue, as much issue with labor. So labor cost is going to start rising for different reasons. Um, but maybe we were getting the inkling of it, right? And maybe we just needed to put some buffer in there. So things are always changing. And again, going back to these are long duration projects, we have to make sure that we're doing some scenario planning and we're incorporating some of those macroeconomic, legal, political, et cetera, all those things into how we're thinking about our planning. The third point here is clear profitability target. And what I mean by that is we have, typically if you're a developer, you're saying, okay, my developer fee, I'm planning for an X% developer fee. If you're a contractor, you're planning for X% of the budget, which your fee is going to be. And architects and engineers have their own sort of methodology. And that's great. But we have to also make sure that we're zooming out from the budget and we're taking we're taking the enterprise into consideration. So, based on the cost structure and the business, your business, um, what do we need from a fee and profitability standpoint, right? What targets are we trying to hit, and how do we make sure that we are taking on those projects that are only meeting the threshold that are going to get us to where we need to be, either from profitability, IRR, whatever that case is. How does it fit into the bigger picture? And so planning for that and looking at that is an important piece of the puzzle.
Projects with continuous forecasting and scenario planning are 30% more likely to stay within budget compared to those without.
Okay,
All
so
right.
this is my the support for the statement that I said earlier, right? Is that 85% of construction budgets are more likely going to be 10 to 20% off, right? But how do we mitigate that? How do we do a better job of making sure that things are in budget or going to plan like we originally planned? So scenario planning is huge. And what it does is it forces us outside of just trying to come up with the best case scenario. And it makes us think a little bit more about what the different risks are and how we can quantify those risks. And then our final budget ends up being more informed by sort of that variation of those scenarios. So let's look at let's see. We have an example coming up here. So we're going to talk about an example pretty soon, but here's some of the best practices. So I've already talked about scenario planning. There that is, and we'll look at an example there. Keeping rolling forecasts. So we're making sure that as we go month to month, that we are updating our projections and our schedule, right? And that's giving us the visibility that we need in order to make decisions, make adjustments, ideally ahead of time before we're in a emergency or crisis, okay? And then technology is really the kind of sort of foundation that holds a lot of this stuff together. And I'm gonna jump into that a little bit later on. But using technology in order to utilize these tools is critical. All right.
I saw a post about that today. I'm sorry to interrupt, but maybe you can touch on this later, just on the technology. It was specifically from a real estate developer, and he
Yeah.
posted something like Hey, I'm old school. Like the real estate development space is old school. Like I use my notepad, a pen, and a little bit of Excel. So, and I'm, doing well. But he also said, I know I'm not going to be able to stay in this space forever. This was in regards to AI. So
Hmm.
hopefully you'll touch on it later, just
Yeah.
really integrating technology, but also keeping it simple so folks can actually use it. So
Yep.
not to
Yep.
interrupt, but that did come up about sort of the real estate development industry.
Yeah. Yeah. And I can talk about that a little bit more later. But the one thing that I will say is, depending on the scale that you're working at, it becomes more important as your scale goes up. And what I mean by that is volume, number of transactions at any given time, and people involved. Technology really becomes very useful when you have that, because complexity is just expands exponentially when you include much more people and more value.
Okay.
Okay, so let's just take a look at this. So I like to graph things out, and this is sort of helpful just to kind of visualize what I'm talking about here. So here, this is sort of a chart showing a scenario for a project. Now, let me just orient you to, let's see where we are. Here we go. Okay, so if you look down here, the example here is this is the development project. Yeah, you can look at these as different milestones. So it doesn't have to be development milestones. It can be any types of milestones that you're working on. Um, but we've got planning, design, construction, and then close out here. That's the timeline. Those are the phases. And then we've got the dollars here in terms of the budget. Now, what is helpful here is, we've got the base case. The base case is right here, right? This is what we planned. But then we've got we got a best case scenario where, say, costs come in lower, so we got lower costs, and then worst case where costs are higher. So if you think about that quote from above, it was the one that talked about projects being, call it 10 to 20% off of of what the plan was. So if we're just talking about simple, easy rule of thumb, right? We can put together a scenario where we're saying, okay, well, what if, so if this is our budget, what if we're 10 or 20% off in any direction? So if it 10% to the good, 10% to the bad, or 20% to the good, 20% to the bad. So what if that was the case? Now, the question then becomes, after that, you do that, once you look at that, and you look at that, the worst case scenario, could you live with that outcome? Okay. And 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 then the next question is, if the budget does go in that direction where it's that much higher, what are some of the kind of pre-thought out actions or plans or things that you can put into place or remove, whatever the case is, in order to mitigate that jump, right? So we're thinking about this in advance about how we can actually mitigate and how we can we can we can we can solve an issue before we even get there. So that's one thing. Um, the other thing to notice about this graph here, and this is just part of the reason why I like showing it like this, is when you're looking at, if you're going to do a scenario, so you have your base case, and the next level of really doing a scenario analysis is you're looking at the particular phases or milestones, and you're saying, where are we more, where is my risk in terms of this thing can go get pretty far out of control. And so it's not just a linear 20% across the board, for example. And so when you look here, you see at the construction phase, you see how this gap widens, right? So we have this sort of this gap here. And then when we start getting over here in terms of, the risk is much greater for a wider gap. So if you're doing your analysis, you're really just taking a little bit further step into where could things go wrong at and what's the magnitude in which they could go wrong at. Now we're hoping that doesn't happen, right? We're hoping for the best case scenario, but if we look at, let's be real, we look at the quote above, this thing is this happens. So looking at it from this perspective is a way, and you can even graph this out also. I like to just, so that some people just look at numbers all day like I do, and you can be fine with that. But having a visual of how this could go is a way to do this as well. Okay. So let's move on. So the next thing here is, so we talked about the scenario analysis, right? That we will do. But then there's the rolling forecast. And what does that mean? That means that once we create that budget, we create that scenario plan, we come up with the ideal or the what we think is a solid base case budget. And once we put that into the place, the next day it's going to be out of, it's not going to be right, right? Because, you know, none of these things fall into place perfectly. So we have to accept reality, right? And say, okay, that was a budget. Now let's look at where we are. So let's say we started this project in January. We're now in June. So this is the green line here. Okay. Now, if you look at the blue line is what my forecast is, right? So we're sitting in January, we're sitting in June, and we had a discussion with the project management team, leadership team, and we're saying, okay, here's where things are going, or here's where things have been trending. So you look at the trend, right? We've been below our target, and we may continue to be below target. So we had that discussion, and then we start planning around, if this is the case, then what do we do? Or how can we change this? Is there a way that can we go back and can we negotiate um, with our developer, investor, owner, whoever the client is, and say, here's the challenges that we've had, X, Y, and Z. So, you know, we need something different, So there's any a number of ways that we can handle this. But the point is that by having this visibility, we can actually begin to start proactively having these conversations and start taking action that will help us in the future.
So how can we manage cash and project profitability in the midst of uncertainty? Talked a lot about change earlier and
Yeah.
multiple levels of change. So when people are shaken up and there's uncertainty, how are they able to actually keep up with the things you're talking about?
Yeah. So this goes back to, almost in a sense, back to the pen and paper, right? Um, we have to be we have to be proactive, and it's really sort of in the details. It's really about being consistent
Hmm.
with our approach to managing both the cash side as well as our margins, our IRR, whatever we're working on. So we have to be proactive and consistent with what we're doing.
The average payment cycle in construction is 83 days, which significantly impacts project cash flow.
Yeah, yeah. So this is pretty common. This is no surprise to anyone on the call here. This is fairly common, and it's just the reality of the business. So that's why working capital management, cash flow management is so crucial in this business, because we know that it's going to take time for us to get paid. Other industries, there's depending on the industry, they may be getting paid in 30 days. Some people are getting paid in 15 days. 45 days. But this business, it's 60 to 90 days is 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 really where it's at. So let's talk about how we deal with it. Okay,
Mhm.
so the first thing here is liquidity planning. And so what do I mean by that? So first we start with the I call it the house or the enterprise. So the business itself. So having a liquidity plan in terms of having cash reserves on hand is ideal, that is set aside. And as you saw, because we're not getting paid to 83 to 90 days, right? We need to have a a full enough cash reserve. And I like to say 3 months of operating expenses, which is about 90 days of cash reserved for any hiccups, anything that goes wrong in the business. So that's one. So that's, call it, the first level. The second level of that is related to our lending capital. So we need to make sure that we are staying in constant communication with our banker, and that our line of credit and make sure that that line of credit is available, make sure that we know when those renewal dates come, because we don't want to get caught off, making sure that we are clear as far as there not being any blockers from us being able to draw on our line of credit when we need to, whether it's for the enterprise, for the business, or for it's a particular project. So always making sure that we're good on that front is critical. It's 100% critical. And then the other thing is when we're talking about your construction loan, or when we're talking about investor capital, being proactive there as far as it relates to how when we're pulling down funds, and making sure that we are being we've got our people, that our people are in place to be able to transact quickly, and pull requests for funds, and that our relationship with our lenders and our investors are are open, and so that we don't have any issues, and we don't have any crunches when we need capital in order to move forward. The other thing is looking at other alternative sources for financing, like factoring, receivable factoring, is helpful. So having a variety of financial resources, lenders, investors, etc., that are ready and available. You may not use them all, but having that readily available is key. And part of how we do that is communication. And then we make sure that our numbers are kept up to date, like our monthly financials are kept up to date, and we are sharing them with our lenders and our investors, to the extent that we need to consistently, so that we're all sort of on the same page. So that's important. The second piece down here is working capital management. So working capital management, what does that mean? That means that we want to collect cash as fast as possible, right? And we want to manage what we owe to other people. And here's what I mean. So keeping cash flowing through the business is critical. And part of the way that we can do this and stay on the same page with the people on our team is to come up with practices or policies about how we manage cash. So what do I mean by that? So for example, when we're talking about receivables, and we're looking to collect receivables our from our clients' customers, right? We're making sure that we're invoicing right away, like very quickly. I even have in those groups that they invoice even before, like, they hit a milestone or before they need to, right? Because that having that the clock starts once that invoice goes out, right? Because we know it's going to take 80 days or whatever the case is for that money to come in. So having that go out as quickly as possible, and that's where a system can be a CRM, not CRM, but our ERP, or a system can be very helpful with that. So making sure that that is happening quickly as possible. And then also, what is the protocol when our receivables are 60 days out, 90 days out, right? Like, how are we reaching out to our clients, customers, et cetera, to collect on those, right? And that should be consistent, right? And ideally, it's not manual, That's why, again, technology is helpful for that. And what is the at what point does the issue need to be raised with management or the owner, right? And the owner reach out and call. So having a, call it a process or policies for how we deal with that is super important. Um, and then on the payable side, like when do we pay, right? When do we pay? Like if we have 30-day terms, for example, um, then we need to make it clear to our accountant, accounts payable people that we pay 30 days or 45 days or whatever the case is, right? Because there are cases where people working in the accounting department, they may pay as soon as an invoice comes in, right? And we weren't expecting that. So we have a lot of cash going out and we're like, hey, so it's a management game, right? So we need to make sure that we're managing it and having practices and policies defined with the team ensures that we're being efficient and we're all working on the same page in order to collect that cash that we need. Cash flow forecasting is another thing, and I'll just go here. I'm just going to flip to this slide here just to give you a sense of what I'm talking about. So this is a graphic. This is one of the tools that I use. But if you look at this here, you know, the goal here is to forecast out for this type of business. Our goal is to look out 60 days, but ideally 90 days, right? So if you can imagine, so we just finished up January, for example, and we're sitting here in February. So let's go out 3 months, right? So ideally, we're forecasting out here 3 months. And so we're estimating when cash receipts are going to be coming in, and then we're projecting out when those payments are going to be going out, right? And so the whole idea here is that no surprises. That's the name of the game in finance. No surprises. Okay. So we know in this example, uh, cash is going to be, as you can see, the ending balance right here at the end of April, 300,000. Now we need to set a threshold, right? I talked about having a threshold, like we want to have at least 3 months of cash, for example, on hand. So whatever that dollar amount is, if we are below that dollar amount, then we need to have a discussion and we need to start making some adjustments on some things, right? So maybe it's managing cash out. Maybe we're pushing out payables a little bit further. Um, maybe we're working with new customers to see if we can pull in cash faster. So there's a whole host of things that we can do in order to manage this. But for this business, because we're long cycle projects and we don't get paid right away, we need to be looking out 90 days is ideal in this case. So
I was going to say, so what I think I hear you saying is when your bills come in, hold off on paying them, but push your invoices through so people can pay you faster. That's how you keep the flow going.
that's working capital management.
Yeah.
That's right. That's right. Okay, so let's flip on from that and talk more about on the profit side of things. So there's a few points here. Um, and this going back to the kind of the pen and paper, this is where we start to get a little bit more detailed, right? So we're tracking profitability, we're time tracking. So let me say something about time tracking. Depending on the business and the business model, if you're architect, engineer, even to some extent developer. If you are looking at how time is being allocated, it is much more, you have much more visibility to help you understand how profitable you are or how not profitable you are, right? But this is crucial for projects. We're working on projects, understanding this because utilization is what um, is what we're tracking, particularly in the real estate services, in order to judge how efficient the organization is. So this tracking, because this time tracking, time equals dollars, and my time and that I apply to a project, I'm looking at that relative to the income of that project to see how profitable or not profitable that project is for us. We look at the rework. So rework is huge because even if we're spending time where we have billable hours going to a particular project, it's harder to tell if our utilization can be very high, but if we're just going back and we're reworking or we're fixing things where it's a drag on profitability, right? Because there's no new money necessarily coming from that if you're working on a fixed fee project. So understanding rework and how we can move beyond that, and that's again part of the postmortem that could help with that. And with that learning is huge. Change order governance, like understanding what is the impact on our returns as and our profitability as we, if we've got to make changes or if they're proposed changes. Okay. So those are a few things, and I'm going to talk a little bit about dynamic forecasting here. Okay. So with dynamic forecasting, what that means is we're talking about consistently updating our forecast, just like we did in the earlier slide. But what you notice here is we've got the revenue side up here, and then we got profit down here. Okay, so the green is what our actual is, the blue is what we've updated our forecast, and then the dotted line there is what our initial forecast, our initial budget was. Similar down here, where our actual is purple, and then the updated is red here, and then this is what we initially budgeted, right? So again, the same principle applies. What this does is it helps us with visibility and helps us to make decisions early about whether or not we need to make some changes in the project, right? And also helps us to make decisions cash flow wise, because this is all translating into cash flow. How does it impact our cash flow? How does it impact our profitability, our returns? This needs to be understood, and what's the impact of it, so that we can properly manage the organization's finances appropriately.
Okay, we're running a little bit low on time. We have about 10 minutes left, just FYI.
Okay.
What advice would you give to real estate practitioners looking to improve financial performance on every project?
Yeah, so being proactive and really setting performance targets and really just um, um, managing the business, managing the financial components against those performance targets. And here actually, so yeah, so I have this slide here is a scorecard, and highly recommend it if you're not using the scorecard. Um, um, it's super important. But let me tell you how this one is working here. So what I have here is that project A through E. I've got, important KPIs or metrics to me, right? So how for this project, how long has it, how long does it take for me to collect, receivables or collect cash, right? Utilization rates, like are my people billed out? Like what's the billable rates on this project? Um, Profit margins, and these are projected profit margins, projected return on cost, projected IRR, schedule variance. So schedule variance is where we are looking at how it judges how much we should have earned at a certain point of time versus what we actually earned. So sometimes that's positive, and sometimes it's negative. And really what that does is if that variance is off, it's most likely off because the project is either delayed or ahead of schedule.
Hmm.
For example, this is a positive variance, $20,000 variance, right? That means that probably means we're ahead of schedule. So good, no issues there. Project B has this negative variance of 20,000, and that means that we're behind schedule. So that's the way to think about that. And there's like a formula to it, and it can be looked up. And then we've got net labor multiplier. So this is this is revenue relative to labor time, right? And so we set targets for each of these, and we look at it across our projects that we have going on. What I've done here is I've created an average. So there's an average for each of these projects and a target. Our overall target for this, for example, for collections is 60 days. Like we want to see that. And so our average is 80. So we're above that in a bad way. So that's why this is red. And on and on. So having a scorecard where we can spot out issues or challenges early, ideally early, then that gives us the ability to be able to make changes as quickly as possible. So many ways that you can do this. You can do this even on a monthly basis, but it is, or even weekly. But this is a crucial part of managing and keeping a pulse on the business.
And it's nice that you have all of the projects on one page, like back to the self-proclaimed old school developer guy who was like, I just use Excel. Like this still feels simple enough, but it has all the projects together on one scorecard, which is nice.
Yeah, yeah, and the simpler that you can make it, the better, right? It's well, we don't want to add in much complexity. We want to make it simple. That's why there's not 100 KPIs here. You know,
Mhm.
we have to have it. We have to keep it as manageable and look at the most important things that are going to impact the business. Okay.
So within just a couple minutes, let's see if we can get through this last part. What systems can help teams with managing data?
Okay, so this is pretty quick. As I talked about before, it is crucial that we have systems and technology in order to support. And as I said before, complexity multiplies when the more transactions, the more volume, and the more people you have involved. It's exponential, and so managing things on a spreadsheet can be very difficult. I love Excel too. I'm like the guy, I like Excel, but Excel can fall short in terms of efficiency and accuracy when you've got so much things that you're managing and that you need to keep down. So here's just a couple of things here. I've got just listed here. Some of these I've used, some of them I haven't. But project management tools, Asana, Monday, Uninet, Deltek, for project management, for budgeting and forecasting. Procure is big for construction. Um, QuickBooks. And let me say something about QuickBooks. A lot of people use QuickBooks to start off, which is cool and good. But at a certain level, um, QuickBooks begins to slow you down. And so if you're feeling pain with QuickBooks or you feel like the system is not, it's things are not flowing as well, you may need to upgrade to one of these other systems that are specific for real estate project management, like Procure or Uninet or Deltek. They are actually built specifically for this type of work, and it'll make your life tons amount easier. So just keep that in mind. And then cash flow management tools and KPIs. So these are all different areas that are different tools that you can use in order to help with uh, with managing all that data and making sure you have the visibility that you need.
Yeah, and it'll make your life easier eventually, right?
Yes, yes,
So let's just be
yes.
clear that
That's
when
100%
our
true.
clients adopt new
It's
systems,
hard.
there is a transition phase, right? It's possibly hard before it gets easy.
Yes, yes. It is 100% harder. So you have to be ready for it, and your team has to be ready for it because, yeah, not everyone is going to accept it. Uh,
Quick question in the chat. What's the level where QuickBooks slows you down? Is there a certain number of projects or a certain like revenue amount?
it's not. It's not a. It's not. It's more nuanced than that. Um, if you're experiencing pain with QuickBooks and if you're using a lot of other systems to augment QuickBooks, that's a sign that you may need to have a more comprehensive solution where the data is going to talk to each other, and you have different disciplines that are also involved in the system, so that you have much more cohesiveness and synergy. So QuickBooks can do as much as you want, but it could be very painful, just flat out.
So for example, if you're looking to build out a forecast or do some reporting for your investors, and in order to build that out, you've got to pull data from 5 different systems, right? Then it's kind of clunky. Is that what you're saying?
Yeah, that's part of it. Yeah. So like if you need timesheet data, you need HR information. Um, if if you need pipeline information. So if you're pulling it from all these different systems, for a while it could be okay. But what you'll realize is that you're moving data around, and it's just not efficient. And your people are working very hard in order just to keep it all together.
Okay, thanks. That was the question in the chat.
Okay, so just a last couple of quick points here is what we talked about is making sure that we're approaching your budgeting and forecasting process, and doing that scenario planning, making sure that you're looking at the past, right, in order to inform the future. Like establishing a financial review is key. So weekly and monthly. So weekly, when you're looking at metrics, monthly metrics, as well as the complete financial packages, keeping you on track. And then those KPIs, and of course technology, which I just talked about, and I already hit on this post-mortem. Like this is key to improving the business and improving what you're doing.
Bravo, excellent job. Thank you so much. That was super helpful. I know we didn't really leave a ton of time for questions, but you guys can always email us. Thank you for joining. We are hosting monthly webinars, and so hopefully you found this very useful. We will be sending out the recording to those of you that are here and those that could not make it. I added a link in the chat to schedule a discovery call, because obviously this was general, but you might have something specific that you want to talk to James about related to your business. We're happy to do that. Feel free to click on that link to schedule a time. You know, I stay on LinkedIn, so you can also message me via LinkedIn if you would like to get that discovery call. But thank you all so much for joining us, and we will see you next month.
Right.